Counting on the last.
Are we going to be visible the whole time?
Yep, and we are live, letting the participants come in. Wait just a second while the system lets the folks in the waiting room join. So we'll go ahead and get started. This month's Landowner Insights webinar. We are working on a handful of pretty interesting things that we want to communicate. We've been reaching out and have a lead on some folks at USDA to help talk a little bit about what's going on with the current administration and give a little bit of feedback, right? And help us understand the policy path forward. We're also going to start a little series on Landowner 101. Where we kind of bring it back to core roots of helping folks understand the path forward with various different sort of 101 style questions that they may have with their farmland. What we want to do today is a little bit of a regional roundtable. So we've got George Baird with us, manager down in the Delta, our boots on the ground in that region. Curtis Buono, broker out in the Pacific West. Kind of giving us some insight over there. And then Hunter Norland, Director of Acquisitions with Capital Markets, who is spending quite a bit of time these days across the Midwest and Northern Plains, also can give some insight on what we're seeing and help me out with the Pacific Northwest region as well. And there's a couple of themes that we want to jump on here. The uncertainty kind of thesis is pretty core across the ag sector and the farmland ownership sector right now. 2025 has several elements of uncertainty. As we go through some of these things, there might be a little bit of a negative overtone. We do feel pretty good about a number of opportunities that we want to call out as well. But that uncertainty theme, it stems from tariffs and how the strength of the dollar is going to impact some of our export markets. We do have this farm bill negotiation that's in process. They kicked the can last year, and our feedback right now is that there's still a good collaboration, a little bit of bipartisan support, which has been historically the case with the Farm Bill. Where we land relative to some of the budget goals that exist, that's certainly an element of uncertainty. Cost of capital, there's been some good news recently, particularly when we're talking about asset purchases, a little bit lower cost of capital. That trend's continued, but what's going to happen long term with inflation is certainly one of the stories that we're paying close attention to. When we look at Doge and USDA and what's going to happen from a staffing standpoint and a funding standpoint, there's a lot of questions that remain out there, and we're trying to work on helping get some information and some insights into how that's going to play going all the way back to funding that was allocated with the IRA. I think that's important to understand how that's going to fit into the equation just a little bit. The renewable energy policy, particularly for us in the feed grains arena, that there's some uncertainty there as well. Also a number of opportunities that we see emerging too. So that uncertainty theme certainly fits into part of it. We had some good news. The Emergency Commodity Assistance Program is open now. So that's $10 billion that'll get pushed out into the system. On the low end, about $30 an acre for soybeans and wheat, and on the high end, cotton at about $85 an acre. As per typical on these policy structures, George and the Delta boys seem to win a little bit. So we'll talk about that just a little bit more. When we put all of these things together, the different regions and different production systems are having different outcomes, and we certainly see some divergence in terms of how some of these uncertain elements are impacting different regions. And that's where we wanted to just get our boots on the ground together and just have a little bit of a conversation about what we're seeing out there. So we'll start in the Midwest here. I've had several conversations with working capital lenders, and generally speaking, cash flows are a little tight. The majority are fairly close to break even or maybe slightly negative. That's an issue that they're working through. There's a lot of balance sheet strength through the Midwest, though, so we don't view that as a big problem. It is creating some opportunity that I'm sure Hunter can give us a little bit of insight on. We're kind of seeing a bifurcation in the market in the Midwest where high quality, highly desirable assets are continuing to maintain price and value. And you still see some headline style sales, $25,000, $28,000 an acre when you get really competitive environments. But that mid to lower quality tier is a little bit more chaotic. And the Iowa State survey, as an example, for 2024 had land values down about 3.1% in the aggregate. So Hunter, I'm going to kind of ask you a few questions and get a little bit of your insights. I mean, what are you just generally seeing on deal flow, thinking about that Midwest kind of northern plains and maybe even into the lake states just a little bit?
Yeah, deal flow in general has been steady, but slightly below average, I would say. I mean, I keep preaching that, inventory levels are still low compared to average from what we've seen the last few years. Not 100% sure what's triggering that. If you look at the auction calendar across the Midwest this spring, I would say there's less volume of auctions. So that's one thing. And then, we're already at the end of March now. So I think most of the inventory that we were going to see come on the market before planting season's already hit. And again, I mean, it's been steady, but it's been a lower amount than normal. As far as land values go, again, to your point, we're seeing a bigger spread between high quality and low quality ground. And you'll see that in these kind of markets, right? I mean, there's no question about it. We've got a region in Illinois. We actually have acquired a few farms in here recently. And in the last month, within probably a 10 to 15 mile radius, we've seen prices anywhere from $9,000 per acre all the way up to $20,000 plus per acre. And again, I think your high quality Class A strong farms are still selling well, but anything with blemishes, issues, drainage problems, fence lines, you name it, those are starting to get priced in and discounted or just left on the sideline and not engaging much interest besides from investors. So that's one thing. And then to your point with talking to a lot of these lenders, cash flows do feel a little tight. I mean, when you look at the crop insurance price for corn, you feel a little bit optimistic. When you look at conditions right now, you feel a little bit optimistic. Soybean prices could be better, obviously. And I think there was a lot of tough conversations had within the last 30 days, right? I think a lot of folks went in and renewed operating lines or tried to on March 1st and had a tough conversation. So that's triggered a few more of these sale-leaseback conversations we've talked about before, which is not a bad thing, right? I mean, it's a strategic decision more times than not, unless it's forced. And we're working on all spectrums of those, whether it's strategic or forced. And sometimes it's just what you got to do. And you compare that to your cost of capital right now, too, if you're going to go buy more land. And sometimes it does make sense to sell off a piece rather than take on more debt. So quite a few different things we're working through here in the Midwest. But that's just a little summary.
Yeah, so that sale leaseback theme is one that we're seeing in a couple of regions. When we dig just a little bit deeper into that, you mentioned seeing that pretty clean. Hey, I've got an 80, a 160, etc. Where let's just create a little bit more liquidity. I want to maintain the farm, but they're not married to it. You're seeing those scenarios where there's maybe some legacy assets, family type of assets where they want to buy back. How's that mix coming in? Like what sort of reaction to the calls that are coming in and how that's made up? I mean, are you seeing mostly just, hey, let's create a little liquidity, or some of those scenarios where maybe there's a little bit more of a hint of some real distress?
Yeah, it seems about 50-50, I'd say, which is a pretty generic answer, but it really does, right? I mean, you've got, like you said, legacy assets that come up for sale. And we always say there's farms you want to own and there's farms you need to own, right? And when there's farms you need to own, that's when you start looking at, hey, what can I sell off that maybe makes more sense strategically? And if I can retain those acres to continue to lease them, does that make sense in my operation? And at the same time, if somebody's looking to sell farms, that's usually the last option. And so when we get that call, sometimes you do wonder, okay, how bad is the distress and how much force is there on your end to sell? So I would say 50-50 is kind of the mix. And on the rate side too, it's kind of interesting. I mean, we just saw some short-term rates come across that were hitting that 6% mark, or even maybe sub 6% for the first time that we've seen in a long time. So there's a little bit of optimism there. But again, with to your point on the inflation side, who knows what the future holds for that.
Yeah, so you mentioned that there's a couple pockets or maybe a specific pocket in Illinois where you've gotten some deals done. Is there any sort of themes or patterns you're seeing from a regional standpoint through the Midwest, Northern Plains, where there's more opportunities than others? Or are they still just pretty much kind of floating up one-off?
A lot of one-offs. Yeah, no general trends I can really speak of.
You know, when we look at the themes, right, we talked about the sale leaseback. One of the interesting dynamics that we've got broadly in farmland right now is the institutional owners. And this is going to be, when we're talking Midwest, a little bit more Illinois than probably anywhere else, generally speaking. They haven't been raising as much capital. There's been a lot of assets that are entering the end of life on a fund that might be a 10-year fund. And then there's some assets that'll be a little bit more prevalent where George and Curtis are working. But what have you seen from some of the institutional assets? Is there a significant increase in dispositions? Have you seen more acquisitions? Like, what's that institutional theme look like?
Yeah, that's a little bit of a mixed bag too, surprisingly. In the last 6 to 12 months, I think there's been a lot of institutions that have recognized that a softening was going to come on land values or was already here, and let's take some chips off the table or capitalize on what the land market's doing now versus what it's doing in the future. And so there's quite a few sales to end last year, and even some that started this year that we've seen come across. At the same time, I think there's actually been some institutions that have come in because of that, right? If folks are recognizing, that we're 10, 15%, maybe more off the peak of what we were 2 years ago. And again, when you start talking cost of capital on some of these sale leasebacks, an operator can actually afford to pay a little more in rent versus pay more on their interest expense or their carry cost. And so you start to do some of that arithmetic and calculation, and it can make sense for some of these groups. And so a little bit of a mixed bag, but yeah, we've seen both institutions selling and buying, but I would say more selling than buying if I had to compare the two.
How would you outline the general sentiment? Like, if you're going to just say an aggregate sentiment of the farm operators, you're spending a lot of time on a daily basis talking with farm operators across the country, but specifically in this case, Midwest, Northern Plains kind of region. What's that? What's your general feel?
Cautiously optimistic is how I would put it. I mean, anyone can find any reason to complain and cry the blues like anything. But I would say in general, I took a tour of northern Iowa yesterday. I actually met with a lot of our tenants and looked at a lot of different farms, and conditions are good. And then hydrous is going on. And we actually got a call today that we had a farm in southern Illinois actually get planted to corn today, right? So there's a lot of optimism out there. And I think everyone's just kind of used to the new normal now. We kind of feel like land values are starting to plateau a little bit, settle in. Rates have kind of settled in, commodity prices have kind of settled in, so it's back to business and business as usual, it seems like. So again, cautiously optimistic, but to your point, the uncertainty is what can keep a guy up at night.
Yeah, it does feel like balance sheets through the Midwest are holding pretty well, and that makes sense, right? We've had a 41% increase in farmland value since 2020, even with a little bit of settling here over the last year. So that's been a pretty big boost to a lot of owner operators, certainly. So, hey, George, I'm going to move down to the Delta just a little bit, and let's start to dive into what you're seeing. It sounds like your guys' growing season is maybe kicking off a little early this year.
Yeah, we actually started, typically we'll start in Louisiana the last, kind of the last week of February and start moving up. They actually were delayed a little bit because of very wet weather and some cool weather. And then about 10, 12 days ago, it just broke loose. And we're seeing basically now from I-40, so Little Rock to Memphis South, planting of, mainly corn, but I've been hearing a lot of beans go in this week and a fair amount of rice in some pockets all the way to Louisiana, and they've really caught up and sped up. So we're probably actually 2 weeks really ahead of schedule. Matter of fact, some guys they've missed rain 2 nights ago, and we're kind of hoping a little bit more so they would, Mother Nature would put the brakes on versus them just kind of taking off. And if we don't see, and the forecast looks really good too, and I was talking to a few guys today, they're still going to hold back. Because if you look back historically, now is kind of the perfect time to be planting corn. But if I look at all of the farms I've managed over the last 30 years, kind of by mid-April to the latter part of April, that tends to be the sweet spot on rice. So you don't want to get too crazy because we always have that kind of that early April You usually say Easter, cold snap. This year, Easter's a little bit later, but that early April cold snap, that that the seed would be better off in the bag than in the field. Especially when you look at a crop like rice, there's a shortage of some of the better varieties of rice out there, and you can't get enough rice for what you want to plant, and you dang sure don't want to have to replant multiple acres over. And even the rice that's out there, we're hearing some low germ rates on it. So there's a lot of scrambling, a lot of looking around for rice acres and that people are going to. But cotton, we're still way up on cotton. Beans, starting to see a few, and that'll ramp up as we get to the 1st of April, and we'll go from there.
So across your portfolio, you work with a lot of your clients acquiring new farms, paying attention to what's out there, or in some cases helping them maybe do a disposition if they're trying to make a trade. What are you generally seeing high level across the Delta in terms of land values?
The theme that's holding true in the Midwest is probably the same here. That highest quality property, those farms are staying really close, and I think you could argue up or down 3 to 5%, and that'll just be based on some local economies in there, maybe something that's triggers up or just in the right neighborhood. But these B and C and especially D quality properties, we're seeing those come down, I think, pretty rapidly. And some of the properties that are coming on the market that people perceive, maybe the landowner perceives as, cropland A, when you really step back and take a look at the amount of development and work it needs to bring that up to A, you've got to discount it appropriately. And landowners are, especially the investor side, they're taking every bit of that into account. It's not just the cost of the well, the drainage, the leveling, and the irrigation, but it's also the time and cost it's going to take to convert that, to bring that farm around to get back on highest quality production capable. And so we're starting to see that bifurcation in land values as well pretty quickly. And I think it's just going to accelerate. What we haven't seen that I'm a little bit surprised of is we haven't seen tons of stuff come on the market yet. We've been popping. It seems like about every 3 or 4 weeks we'll hear 2 or 3, 4 things, and then it kind of gets quiet again. But I think we're still going to see a number of opportunities pop over the next 3 to 6, 8 weeks. I heard of 3 different producers in one county today, all getting told no. And 2 of those don't have any land assets, which was one reason they can't go. And the other one does and is likely to sell off a portion of the portfolio to clean up debt, sell out his equipment, and just ride off without any with any debt to carry, as he goes to retirement. We're probably seeing, I've been saying 10 to 15. I think it's going to be at least 15% flush in our farmers this year. 60% of those are guys that have been farming the last 3 or 4 years thinking about, retirements down the road. But, it's so good. Why do we get out now? Now they don't want to burn that additional equity. So they stayed in and now they're choosing to get out. But that other 40% of the 15% is maybe those younger farmers that didn't have that asset base to really fall back on to prop up beyond 25 and into the future years.
That's a pretty bold one. So let's just dig into that. So you think that something in the range of 15% of the farmers in the Delta will be out across 2025 based on some combination of retirement and or financial distress. Did I hear that correctly?
Yeah, between 24 and 25, I think that's true. Now, I think the majority is retirement, guys that have been thinking about it anyway. But when rice is $7.50 to $8, and corn was +5, and beans were trading well over 10, good yields, good prices. Why get out now? And but it's changing pretty rapidly. I mean, when you look at the spreadsheet, in our market, and we have higher costs generally across the board for different commodities. And just looking at some costs and returns I pulled today, like there's, on a basic crop share farm, there's only one crop that shows a positive return based on average input cost. And we're not plugging in, $9 beans, but we're not plugging in 11. You're talking 10.40 beans, 4.90 corn, 72-cent cotton, and 6.15 rice. And we're showing negatives across the board except on soybeans. And so everything has to go right. And when people look back, 2023, we had didn't have a great crop, but made the most money we ever made. 25 had the greatest crop we've ever had. Yields across the board were great. Didn't make any money. I mean, in 24. So what does 25 hold? Most everybody's not going to plan on repeating those great yields we had last year. And if you don't repeat those great yields, the red paint just just spreads across your paper pretty quick. And that kind of comes back to, okay, now, the farmers always, especially in the South, we always love to talk about our subsidies, right? And we've always tend to get pretty good subsidies, but when you look at these ECAP payments, they're only 8 to 9% of our overall operating costs, not including overhead. And when you look at soybeans and corn, we're in that 5 to 6%. And I would venture to say, if you looked at your costs, that would probably be, those ECAP payments would be 8 to 9% of your overall operating cost as well. So we got to keep it all parallel. But when I look at these commodity, these ECAP payments, I really wasn't as concerned about an ECAP payment for 23 or 24. My concern is we need more price supports for 25 and beyond. And when you look at these overall, reference prices USDA put out, what was the last time we reviewed those or changed those? 18 years ago? And nothing else has changed as far as price supports, except fertilizer's higher, fuel's higher, healthcare's higher, labor's higher, everything's higher, including our land and our carrying costs. And we don't have that price support to really underlie that. And then you start thinking about, well, they can just give us, raise price supports. Well, the baseline for USDA prices is so low, right? Or USDA supports, because we're bouncing off this high price cycle. Where are we going to get the money for those additional support payments? That becomes a big concern as we look, beyond the next 6 to 8 months trying to get a farm bill. Well, they got to balance it, theoretically, balance it. So where do you get that money for that? And most farmers that are going, there's 4 months ago, I said cautiously optimistic. Now it's just hesitantly cautious. Like they just really don't know which way to turn. And they're really not thinking as much about the next 6 months and getting through this crop, but what happens if things don't improve beyond 6 or 8 months, and where does it go beyond that? If I'm planning on farming for 10 or 15 years and I can't make it through 25, then how does the story
You got a little bit of connection trouble on your end, George.
this year? That's where most guys are
We're gonna have to mute George here.
sleeping at night.
He's complaining too much about the Delta. Hey, Curtis, I'd like to hop over to the Pacific West and dive in. This has been a pretty dynamic environment here for I think extended period a little bit. And one thing that we're seeing, the almond price world is coming back on that cycle that tends to follow roughly that, call it 9-year kind of pattern. And there's a little bit more optimism there. I know there had been just a ton of inventory in the almond world. Granted, a lot of it might be some lower water quality assets or maybe orchards that are in conditions and stage of growth and lifespan that is a little less desirable. But what are you seeing in that almond land market in particular now that we're starting to get a little more optimism on the price trend?
Yeah, I mean, I think you nailed it. Next question. I'm just kidding. Yeah, I mean, there's a lot, exactly what you said, a lot going on. We had a good pricing trend last year, right in time to head into some uncertainty. We export 70% of the crop, so people are kind of scratching their heads on where does this thing go in 25 and beyond. But yeah, throughout, I mean, throughout 24 and 25, there's been well over 200 orchards on the market publicly. And it's gone down since about mid-year steadily. All the nut crops, the three majors, walnuts, pistachios, and almonds, we had over 400 on the market publicly for most of what was it, from March to February this year. We got under 400 in February. But that's across the whole state in those three different types. It's not a property largely. There's a lot of B and C or worse stuff out there. And it varies widely from property to property. I mean, you've got all the major factors: production, water, security, and quality, and then just age of the trees. So there are all those things kind of factoring into it. But there's a lot that's been available off market for a while that's been shopped. We had a lot of distress stuff to work through last year after the Trinitas deal was done. Most of the distress stuff was Q1 through Q3. Q4 was one of the most active quarters we've ever had since we started tracking all this stuff. So the median size of the orchards that sold last year, there were about 90 that we've tracked. That doesn't include like the little 7-acre hobby deals and whatnot. But I mean, the median size is about 150 acres. And I mean, at that price or at that size point, you've got, and this will be telling for you, you've got sub $1 million value to over $4 million value. So, I mean, in that size range, you've got a lot of kind of neighbor and local players, but then you've got some of the more commercial scale or institutional investment type scale deals at the higher end of the range. So, I mean, I'll probably say this again on different questions, but I mean, we've been kind of in a what I think is almost a generational buying opportunity to get deals at reasonable prices. I didn't think we'd ever get back to some of these pricing levels. But I mean, there's definitely optimism. A lot of people are just kind of in limbo right now, wondering how this trade thing is going to shake out and how exposed are we going to be to negative pricing trends going below $2 a pound if we get some serious retaliatory tariffs that impact the grower pricing.
So, you know, you've had multiple years of inventory sort of building up, as you mentioned, and then here over roughly, let's call it the last 8 months, plus or minus, we've started to see some positive price trends that get back into base cash flows that are positive again, if we can hit some target yields. What are you seeing? Are you seeing that inventory that's been there sort of get repriced in the market, trying to adjust to maybe some of the optimism, or is it still just sort of sitting there waiting for the first person that's ready to jump? What's happening with that buildup of inventory as maybe some pricing optimism is starting to float out there?
Yeah, it's a good question. I don't think so I mean, after several years in the red and sub $2 pounds, I don't think we've like converged to a point where pricing is going to push orchard value back up. So I mean, I think there's a ways to go before we get there. Some of the stuff is just, I mean, some of it's overpriced, some of it's poor water. One thing that we've had as we were in the red was growers cutting inputs, so that negatively impacts production. So I mean, you really need to get under the hood and understand like how much that's been done on an orchard you're targeting and what the implications are there, what the trends have been as far as inputs, and also like separating that from some of the kind of weather issues we've had over the last few years that have also impacted yields. So it's there, you need some expertise and real like knowledge and diligence in these things. Because I mean, if you just look at the sticker and you see something on the market for $9,000 an acre, and then something 2 miles away that's on the market for 35, that's obviously not apples to apples. So there's so much variety. I mean, we've got a very diverse industry. We grow from south of Bakersfield to well north of Sacramento, and I mean that's over 400 miles. Which, I mean, to put it in context for your neck of the woods, that's like as far as Nashville is to Chicago. So I mean, there's a lot of different water situations and microclimates between the those kind of geographic brackets.
Yeah, so let's talk about the institutional side in your region. And obviously, you can look at the NACREIF data. It's really dominant in terms of where their exposure is into farmland, the institutional groups generally speaking. And it's also really clear that it's been rough for a couple years, certainly, probably even a little bit ahead of that. What are you seeing from an institutional standpoint, both on the sell, maybe clean up things that could have been problems, or as you said, I mean, there's some real buying opportunities for folks that are ready to get in. Are you seeing acquisitions, right? Are there some of these groups that, even though it's been rough, they're saying, okay, it's time to go in deeper? What's that sort of institutional theme in your region?
Yeah, sure. I mean, as far as the sell side, I guess you kind of have to bifurcate between the first movers in the institutional space, the guys that were in there doing these investments in the 90s, and the folks that were more GFC and afterwards. So we've seen dispositions for a lot of the institutionals. The first mover guys, I mean, they've got some orchards and assets that are on second or third generation plantings. They got in with essentially no basis compared to recent values, and they've made a ton of money off those. So we've seen some certain kind of suspect water areas where a couple of institutionals have bigger footprints where they've just blown deals out at, I mean, not sub $10,000. So that's kind of been a trend, but it looks bad for the local market. But it also like gets it off the books. They've already hit their IRR many times over. And so that's kind of a trend we've seen where we've seen some of these longer held assets get moved at really competitive prices. And where a sale is a solution versus like instrumental to or important to getting a specific return level. So that's one thing we've seen. And then, I mean, we've seen some other institutionals, like, for example, like I mentioned, Trinitas, that was their one fund was a bankruptcy. And so, and I had a client who I sold their farm for them to Trinitas, and they just bought it back with wall-to-wall, like fifth leaf plantings on it. And they bought it back for $1,500 above what they sold it to them for. And so like basically they got a bunch of free trees. And so I mean, you see those sorts of things where some of the institutionals haven't done well on the exit. There's plenty of guys that got in at higher bases recently that are trying to move assets, and they're going to be stickier on pricing. They're not going to do, like I said, with the first movers, where they're willing to take whatever they can get just to get it off the books. So I mean, that's kind of the trend we've been seeing on the sell side, and there are some good assets that make sense for another institutional to pick up, and pricing's reasonable, and they got in at the right time at the right basis, and that's all kumbaya. But some of the guys that were buying on the upswing and then bought basically into a situation where they're going to experience readying for several years. those guys aren't necessarily super excited about buying. We're not seeing a lot of people say, well, okay, I can dollar cost average down. I think more the performance is kind of dragged on their thinking about permanent plantings, and they're a lot less bullish today. We are seeing some institutional acquisitions and interest. It's just really the pricing's it's three things, right? And it always is for California. The pricing has to be reasonable and right. The production has to be good, and the water has to be sound. So we'll always, I mean, just given how important almonds are and what the opportunity is there, the optionality of the crop compared to some other commodities like pistachios. You've got, I mean, there's always going to be demand there. So it makes sense from an investment play. I think we saw a lot of people spreadsheet farm and try and make deals work, even though they didn't fit their model. And I think we'll probably see a lot more discipline to specific models as we come out of this and get more institutional activity in the space.
I like to say I've never lost money spreadsheet farming, and still batting 1,000 in that arena. Hunter, I'm going to have you help me move to the Pacific Northwest and give a little update up there. A couple of key themes that we're seeing. There is some downward pressure in markets on specialty crops. There's a number of assets that we work with farmer operators on in that arena. Think organic and seed crops, and some of those sort of smaller markets where contracts are getting pulled and downsized. We're even hearing spud contracts on some of the big operators getting pulled back. Certainly sweet corn and peas is one where we've heard a lot of pullback. And generally speaking, as we look across everything we're doing over the country, the Pacific Northwest is showing a little more pressure probably than other regions. We've seen where some lenders are tightening on their working capital, and that's creating some challenges for operators and subsequently landowners. The permanent crop issues are pretty clear, right? Apples and wine grapes as dominant permanent crops up there. Just still the volume, the production is outsized to the market, and that's going to take some time to clean up. Relative to deals you're seeing, Hunter, what kinds of deal flow are you seeing? And is there some of that same theme from a sale leaseback standpoint up there that we talked about in the Midwest? Just price points relative to what's been happening over the last few years. What are you seeing on your work in the PNW?
Yeah, similar comments on deal flow. It's been steady, but lower inventory levels than normal. And again, don't have a great sense of what's caused that here recently. But we have seen an uptick in deal flow, and actually some larger deals actually. And a little bit of that I think is folks just capitalizing on what current land values are right now, right? Like you said, I think we're anticipating a little more volatility out in that part of the world. Some of these specialty crops come with more risk, and even on the dry land side too. Wheat prices are what they are and certainly aren't what they were, a couple of years ago when they saw a run up there. And so steady deal flow, few larger deals coming across. Haven't seen too much on the sale leaseback side, besides maybe a little bit here or there, but I would anticipate that to start to increase a little bit too.
Is there specific crops or rotational production systems that are or areas, right? You get the microclimates up there, and it can be pretty diverse, going not that many miles. Where you're seeing more deals, or I know we've got a handful of things in the pipeline. What's the sort of generalized production system where you're seeing some opportunity?
It's kind of across all systems, really. I mean, maybe a little more on the spud side, maybe a little more, like you said, sweet corn, peas, that kind of thing. But nothing that jumps out at me too much.
Got it. The institutional folks up there, any patterns or themes? Folks ready to move on, folks acquiring more. What are you seeing?
Yeah, it seemed like there was a lot of institutional activity last year. I think there's a little more deal flow, some larger transactions that ended up happening. A lot of stuff happened right before year end. Since the beginning of this year, it's been a little quiet that I've seen, but that doesn't mean there's not things happening in the background, right? So I think inventory levels again play into that. When there's higher inventory levels, there's higher sales and more volume of that happening across the board, including institutionals. So I've been a little quiet lately from what I've seen.
Got it. So not a huge sell-off either, really.
No, no.
Cool. I want to cycle back through, there's George in particular, man, painted a pretty rough picture. I guess Curtis's wasn't too happy either. There's some optimism and reasons to be optimistic. Hey, George, give me some things you're optimistic about, and what's your forecast for 2025, particularly noting where you were kind of hinting at a downward trend on that, call it BC or maybe lower quality assets. What's going to happen in 2025, and what are you excited about? What are you optimistic about?
Unfortunately, anytime there's some stress in the market, there's going to take some people out, but it creates a lot of opportunity. It's going to create a lot of deal flow, and really, if we look back over the last 3 or 4 years, when I was hearing all this deal flow out of the Midwest and other places, we were really pretty slow. It felt like, other than 4 or 5 different institutional investors, rolling out of their 10-year funds or some of their funds that were timing out, there wasn't just a ton of deal flow. Or if it was, you had to be there quickly. This has given us a lot of opportunity to start really looking at different farms, really being strategic about where we're placing capital, where before we might have just been trying to get it placed because we had nowhere else to go. Now we can really take our time and find the perfect property for that client that's looking for something. And then just being very realistic about how we need to price the development cost and the timing of everything into it, looking out. But anytime it's going to create more management positions and more appraisal opportunities for the whole team. And so that's positive. Unfortunately, it'll just come on the backs of some people that were just in a bad spot at the wrong time. So I think we are going to still see, if things don't change too much, the high end stuff really hold tight, and farmers are going to continue to seek out those highest quality properties to operate. We are seeing farmers let go of some marginal acres that are located well away from their farming operation. They're spending more time running back and forth, and it justifies. And so that's going to create some more opportunities for us as well from the management side and acquisition side. We haven't seen many sale leasebacks yet, but I think that's coming. As a matter of fact, I still think in the next 3 to 6 weeks, some of those opportunities are going to come up. Talking to two farmer operators today, and both of them are thinking about looking at different opportunities that they're hearing around. Yeah, but they're not in their own backyard, so let's just be a little more patient. And I think you can strategically make some moves that'll benefit you and your family and your goals long term, instead of just grabbing stuff well away from your headquarters. So it's not all doom and gloom. I think we're going to get it settled. I think some of these trade tariffs that we're going through now, I think that's some strategic positioning by the president and his administration. I think ultimately we'll get that kind of worked out, and we'll get some additional support payments. Think back to the payments we got last time when Trump was in office. If we don't see a new farm bill, I think there'll be some support. And so I try to talk to my farmers about looking at that and thinking about what can be a little bit more positive on the outlook, but sometimes they can't think beyond the next, 4 to 6, 24-hour news cycle. You never know when you turn on the radio or the TV, what's that next thing that the administration is going to say that's going to upset the market. So, but I think getting a good start, we had a great fall, and things are looking up, but we don't really need to see any production pressures this year. We need things to go pretty smooth.
So you got buy side optimism, generally speaking. Curtis, you talked about generational buy opportunities, so you're clearly on the buy side optimism side as well. What's your sort of crystal ball forecast for 2025 in your market?
Yeah, yeah. I mean, I set the table with some, I guess, negative sounding things, but overall, yeah, I'm optimistic. I think there hasn't been an opportunity like this in a long time to buy quality assets and buy them right. You'll just have to sort through some lower quality stuff to get there, right? Yeah, I mean, crystal ball, it's really tough to say. We've had this interesting dynamic the last couple of years, I guess last year and a half. Last year we had two large distressed deals, portfolios, and people kind of waited to see what those were going to do. This year we've got the Assimi deal. That's kind of a similar thing where people kind of pump the brakes to see how it's going to hit and how the market's gonna uptake it. And like I think I mentioned, Q4 last year was the most active we've seen, I think, since we started granularly tracking stuff. So I think that could we could see the market like hang out on the sidelines for a little bit while we try and get some certainty on the trade issues, and then see how this one big distress deal hits, and then after that, hopefully, I don't know if that's going to be Q2, Q3, but at that point, I think we could see a big uptick in activity, and we just grow so many diverse things here that it's tough to make blanket statements. Like almonds and pistachios largely exported, so they're going to be more exposed to retaliatory tariffs, but then we've got other markets, other commodities that are largely imported. And so if we go a little protectionist, I think those guys should be sitting pretty, and we might see people run to some of those commodities, or like, for example, the veg market in the southeast part of the state, Imperial, Coachella, and Yuma, Arizona. Like we go protectionist and get some kind of insulation from Mexican imports, we could see some real good opportunities there. So I think there's overall optimism, but there's also going to be that uncertainty, and that's just going to be the reality until we have a little better direction. So I think we'll continue to have good transactional volumes, and it'll just probably be clumpy as to when those happen with some of the trade questions, and then seeing how this one distressed deal filters through the market.
So Curtis's crystal ball is a little bit of a fragmented market, as some of these uncertainties, some of these questions sort themselves out, and then an opportunity to see some real inventory cleanup from there. Hunter, where are you at? What are you optimistic about? What do you see coming at us in 2025?
Yeah, I mean, again, I'll repeat it, cautiously optimistic, right? I mean, I'm excited because, the opportunities we're seeing, it feels like there's quality farms that can be bought at reasonable prices, right? Prices that aren't sky high, all-time records like it was a couple of years ago, and there's less competition as well. And it feels like, we're selling into this new market, and everyone's trying to figure it out, but I do kind of sense it plateauing a little bit, which when it does that, it's a little more, it's a little easier to figure out. It really is a little easier to operate, a little less uncertainty. I mean, I'm again cautiously optimistic, but again, we kind of have to be working agriculture, right? So, it seems like for every sale I see, that's either no sale or a farm that sells kind of light, and you think, gosh, that sold less than for what it should. There's the next one that sells at a price that you raise your eyebrows, like, oh my gosh, that sold for a lot higher than I thought, right? So you're still seeing a little bit of that volatility here as things settle in, but again, cautiously optimistic, but I'm excited about this year. It'll be kind of interesting.
Well, thanks guys for joining and helping us walk through and get just a little bit of more of a regional perspective. Thanks everybody for hopping on the webinar. Keep an eye out. We've got a couple of pretty interesting ones coming in the next few rounds of these insight webinars that will hopefully add some clarity if we can get some insight from folks in the policy world, and then also getting into this Landowner 101 concept that'll be coming around. So thanks all for joining, and we'll be back in touch soon.